Good morning. It's Jeffrey Christian, CPM Group. It's about a little after 11 o'clock on Tuesday, the 17th of October, here in New York. I want to give an update on our shorter-term market views for precious metals. But first, I wanted to talk about an issue that is being raised by gold promoters. They keep talking about how governments and others are dumping the U.S. Treasury note, and they keep putting forth this whole issue about how there'll be a crisis at some point when no one wants to buy more Treasury notes in the face of mounting debt and deficits. Now, last week we gave a talk in one of these videos about the bond market, and we dispelled some of the myths. And one of the points we made was that the U.S. Treasury securities are still considered the least riskiest investments in the world. They used to be considered risk-free, and everything else was measured against them in terms of risks and reward calculations. They're still considered by some people risk-free, but even if you think that there are risks to holding treasuries, they are lower risks of problems with treasuries than debt from any other country, private debt, corporate debt, consumer debt. So if you got into a real debt crisis, the inclination of investors around the world is to invest in U.S. Treasuries. They will be the last debt market to collapse. But that never stops gold promoters from trying to scare people into buying gold, because the Treasury market is collapsing. And you keep hearing things, the Treasury market's collapsing, people are dumping treasuries, et cetera, et cetera. I wanted to add this one chart to the work that we did last week, and you can go back and find that video and review it. This is a chart of the ratio of bids for Treasury securities, 10-year Treasury securities, at auctions that the U.S. Treasury makes. The volume of the bids versus the volume of Treasury securities actually being offered. The red line's the important one. That is the moving average of the ratio of bids to offers. You can see, this chart, and I apologize, I got it off the internet from a company called Micro, and they want you to buy the things. So when you try to copy a chart, it strips out the years at the bottom. This starts around 1994, 1995, and it also strips out the legend. The blue line is the ratio of bids to offers, the multiple of people wanting the treasuries over the amount of Treasury securities that the U.S. Treasury is auctioning off. And you can see, it's almost always since 1995 been above like 1.6. And it's often, 2 times, 2.4 times, 2.6 times. You'll also see that, from 1995 until 2008, it was, generally speaking, usually below 2.4 ratio. So the amount of treasuries that people were offering to buy were 2 to 2.4 times as much as the Treasury was seeking to borrow. That changed after the Great Recession and the global financial crisis. And since that time, the ratio has been basically above 2.4, getting up as high as like 3.8, right? And you can see here that really from around 2016 or so, the ratio has been basically closer to 2.4 to 3.0. And you can see that really over the last several years, the ratio has been pretty stable. In other words, people are still willing to buy more than 2.4 times the amount of treasuries that a 10-year treasury notes that the U.S. Treasury is auctioning. There is still tremendous amount of demand. The Treasury could actually borrow 2.4 times as much as it has been. So when I hear people say, well, no one wants treasuries and people are dumping treasuries, I'm kind of confused as to what they're looking at, because that's not the reality. But then maybe they're not looking at anything. I just wanted to put that out there. Now, in terms of our market outlook, we had, on a very short-term basis, a week ago, issued sell recommendations for gold and silver. We thought the prices would trade in a range, but were likely to head lower. They did head lower. They've come back up. I guess the primary factor is the risks of the Hamas-Israeli military violence that's going on right now. It's bad in and of itself. There are risks that other countries could be brought into it. It's not clear how that is going to happen. Our view, our assessment is that there's probably a greater than 50% chance that other countries stay out of the battle, but there are real risks that it could widen. There are also risks that you could see higher oil prices if oil-producing nations hold back oil. That said, many of the major oil-producing nations, Saudi Arabia, United Arab Emirates, Qatar, are actually trying to improve relations with Israel, so they probably wouldn't necessarily do that. Iran, which is the sponsor and funding source for Hamas and Hezbollah in southern Lebanon, Iran is an oil-producing nation, but it's the less important oil-producing nation. And it, generally speaking, produces sour crude, which is less desirable than the sweeter crudes that come out of Saudi Arabia and the United Arab Emirates and other oil-exporting nations. So we don't necessarily see that happening. In that environment, we've seen the price rise for gold and silver, but it stayed within the band, short-term range that we were expecting. Our expectation is that over the next several days or the next 10-day trading days, you may see gold and silver prices come back off toward the low end of those trading ranges. Our expectation is still that you will see gold and silver prices rising later in this quarter, but that there's still some scope for lower prices for gold and silver. Palladium has actually broken below the low end of the range that we had. In platinum and palladium 2 weeks ago, we issued our short-term recommendations were sell any long positions you have and stand aside waiting for clarity. And we had ranges for platinum and palladium. Palladium has actually dropped to the low end as we speak. It's just above the low end of the range that we had. That had gotten below that. We're still saying, and we will issue new trade recommendations later today, we're still saying that we expect some further downside exposure for both platinum and palladium. Platinum is held up better than palladium, not surprisingly. But we would still stand aside. We wouldn't necessarily short these metals at these prices. A resolution of the auto strike could occur over the next 2 weeks, and if that happens, we would expect platinum and palladium prices to rise a little bit more. Last week I mentioned we have issued one market alert. We have two market alerts. Market alerts are things, special reports that we distribute to our clients. Typically, we issue them when something happens that is significant in between the issuance of our monthly precious metals advisory report. But we've issued two which are more longer-term thought pieces. One we issued last Wednesday, the 11th, on our long-term economic outlook. It was 10 years of projections for global and regional gross domestic product, including the recession that we have built into our projections for 2024, 2025, and the recovery that we projected beyond 2025. We released that 9-page report last Wednesday. We will issue a companion one called Deficits, Debt, and Gold, which will be talking about not just U.S. Treasury debt, but the much more significant and much more risky global debt beyond the Treasury. The Treasury owes us all $33.5 trillion, but global debt is a vast multiple of that. The Treasury's debt to GDP ratio is about 120%, which is where it was in 1947 after a deep recession in World War II. But on a global basis, the multiple of debt to GDP on a global basis, including not just governments, but also private corporations and consumers, individuals, is around 3 times as much of GDP. So around closer to 280, 300% of GDP. Much more worrisome, higher credit risk, and much larger ratio of debt to economic output. That report will be released in the second half of October. Now that I'm back from a small break for personal issues, I hope to finish it off yet this week. Non-clients who are interested in receiving these reports can become clients now. You can go to our website and you can, we'll also throw in a report from September. If anybody subscribes and becomes a client now, they wouldn't have received it in September on the myth of de-dollarization. You can go to our website. You can sign up as a retail investment client, get those special reports, buy our yearbooks, and get those special reports, become a client. And there are a lot of free reads and past videos that you can watch there. That's all I have for now. Take care of yourself. Take care of those around you. And let's see if we can make the world a little bit better place by doing some good. I'll talk to you on Friday.